Tesla, the name that defined the electric vehicle revolution. The company that made EVs cool, fast, and desirable. For over a decade, Tesla has been the undisputed king of the electric vehicle race. But what just happened? Tesla's stock just took an 8% hit, dropping its market value below $1 trillion for the first time since November. What does this mean for the future of EVs? And can Tesla bounce back before it's too late? The shift is already happening. For the first time ever, Tesla is no longer the world's best-selling EV brand. Chinese automaker BYD just pulled ahead, delivering over 526,000 vehicles, compared to Tesla's 484,000. And this wasn't just a fluke or a statistical anomaly. It's the result of years of mounting competition, strategic missteps, and shifting industry trends. While Tesla has been dealing with production delays, supply chain struggles, and pricing mistakes, BYD has been executing a long-term strategy, one that's now paying off. Tesla's decline isn't due to one major failure, but rather a series of small cracks that have been forming over time. Stick with me, because what happens next could change the EV industry forever. What once seemed like minor inconveniences had finally caught up to Tesla, weakening its grip on the market. Now, the big question wasn't just how this happened, but whether Tesla could make a comeback. How did a company once hailed as the future of transportation start to slip? The complacency trap. Tesla changed the game with its long-range battery technology, cutting-edge software, and direct-to-consumer sales model. For years, traditional automakers struggled to catch up, while Tesla stayed ahead of the pack. But success can lead to complacency. Believing it would always be untouchable, Tesla made some costly mistakes, delaying new models, struggling with production bottlenecks, and letting quality control slip. One of the biggest warning signs? Its painfully slow innovation cycle. The Model S, Model 3, and Model Y dominated the market for years, but Tesla failed to keep things fresh. Customers waited for redesigns and upgrades that never came, while competitors like BYD, Volkswagen, Hyundai, and Ford pumped out new EVs at a rapid pace, offering more variety, better interiors, and competitive pricing. Another growing frustration? Delivery delays. Tesla repeatedly missed its targets, leaving customers with long wait times and unreliable timelines. Quality control also became a major issue, with reports of panel gaps, software glitches, and malfunctioning driver assist features tarnishing its once flawless reputation. Tesla's image as the leader in cutting-edge engineering was starting to crack, and competitors were more than ready to step in. A pricing miscalculation. Tesla made a critical mistake. It failed to adjust its pricing strategy in time. The company assumed its premium brand image would keep buyers loyal no matter the price. But as more affordable EV options hit the market, that assumption started to fall apart. While competitors like BYD focused on cutting costs and offering well-built electric vehicles at lower prices, Tesla kept its prices high, waiting too long to make adjustments. By the time it finally responded, the damage had already been done. Perhaps the most dangerous belief Tesla held was that brand loyalty alone would keep customers from leaving. But the EV market was evolving fast, and Tesla was no longer the only option. Consumers wanted affordable, high-quality electric cars, and Tesla was slow to deliver. Meanwhile, BYD had been quietly executing a strategy that would change the EV industry forever. Tesla's worst nightmare. For years, Western automakers dismissed Chinese EV companies as low-quality and uncompetitive. Even Elon Musk himself once laughed off BYD, believing Tesla had nothing to worry about. But while Tesla focused on luxury, performance, and software, BYD was playing a completely different game, one that Tesla wasn't ready for. Instead of chasing high-end consumers, BYD focused on affordability and mass-market production. It streamlined manufacturing, cut costs, and built an efficient supply chain that Tesla simply couldn't match. And then there was the China factor. Government support helped BYD gain an even bigger edge, allowing it to sell EVs at significantly lower prices while still keeping strong profit margins. But perhaps BYD's biggest advantage? Battery production. Unlike Tesla, which relies on third-party suppliers for its batteries, BYD makes its own. This keeps costs low, stabilizes supply, and allows the company to scale rapidly across global markets, offering reliable, affordable EVs at a pace Tesla can't keep up with. Tesla once led the EV revolution. Now, it's facing a challenge it never saw coming. BYD's success wasn't just about price, it was about scale. While Tesla struggled with supply chain issues and missed production targets, BYD was pumping out EVs faster and cheaper. This gave them a massive advantage, allowing them to dominate key markets and even push into Tesla's strongholds. By the end of 2023, BYD had completely reshaped the EV industry. Tesla was no longer the only major player. Now, it was up against an automaker that could produce more cars, sell them for less, and expand across global markets at an unprecedented pace. But Tesla's troubles weren't just because of BYD's rise. Tesla also made its own mistakes, and those missteps accelerated its downfall. Tesla's price war, a costly gamble. In early 2023, Tesla launched an aggressive price-cutting strategy to maintain its market share. Some models saw price reductions of over 20%, a move aimed at undercutting competitors and boosting sales. At first, it seemed like a smart play. Sales spiked as lower prices attracted more buyers. But the long-term impact was disastrous. The price cuts devalued Tesla's brand, angered existing customers, and slashed profit margins. People who had bought Teslas at full price just months earlier were furious when their cars lost significant resale value overnight. Many even canceled their orders, expecting more price drops in the future. On top of that, lawsuits and complaints started piling up, with some buyers accusing Tesla of unfair pricing tactics. And the worst part? The price war didn't even work. Instead of crushing the competition, Tesla's rivals, including BYD, responded with price cuts of their own, effectively neutralizing Tesla's advantage. Unlike Tesla, which was already struggling with rising production costs, BYD could afford to lower prices without sacrificing profitability. The bigger problem: Tesla's price war exposed a much deeper issue. The company was no longer leading the EV industry. Instead of setting the pace, it was reacting to competitors, and pricing wasn't Tesla's only Achilles heel. The real crisis? A supply chain disaster waiting to happen. Tesla's biggest strength became its weakness. Tesla's gigafactories were meant to be the backbone of its electric vehicle empire. By owning and controlling its high-tech manufacturing facilities, the company aimed to cut costs, improve efficiency, and ensure top-notch quality. The idea was simple: reduce reliance on external suppliers, mass-produce EVs at an unprecedented scale, and build an infrastructure no competitor could match. And for a while, it worked. Tesla set new standards in EV production, revolutionizing automation and battery integration. But as the industry evolved and supply chains tightened, the very strategy that once gave Tesla an edge turned into its biggest vulnerability. Gigafactories need a steady flow of raw materials, but when the global supply chain crisis hit, Tesla's centralized model became more of a bottleneck than an advantage. Shortages of chips, lithium, and other critical materials led to massive delays, forcing Tesla to cut production targets. Meanwhile, competitors like BYD and Hyundai, with more flexible production models, adapted much faster. On top of that, Tesla's rapid expansion brought its own challenges. The new gigafactories in Germany and Texas were launched before they were fully optimized, leading to production inconsistencies, logistical issues, and even labor disputes. Instead of solving problems, These factories created new ones, slowing production and driving up costs. At this point, Tesla was no longer the nimble startup that once shook up the auto industry. Instead, it was starting to look like the aging automakers it once aimed to outmaneuver, struggling under the weight of its own rigid supply chain. And the supply chain issues were just the beginning. As Tesla scrambled to fix production delays, an even bigger problem emerged. Tesla's reliance on third-party suppliers backfires. Unlike BYD, which manufactures its own batteries, Tesla has always relied on third-party suppliers like Panasonic, LG, and CATL for its battery cells. This made the company heavily dependent on external supply chains, leaving it vulnerable to price fluctuations, shortages, and delays. As global demand for EV batteries skyrocketed, Tesla found itself competing with other automakers for a limited supply of critical materials. Battery prices surged, squeezing Tesla's profit margins and causing additional production delays. Meanwhile, competitors like Ford, Volkswagen, and Hyundai aggressively invested in their own battery production, reducing their reliance on outside suppliers and gaining more control over costs and availability. Tesla's overdependence on China for key materials only made things worse. With over 70% of the world's lithium processing concentrated in China, Tesla had little choice but to rely on Chinese suppliers, despite the growing geopolitical risks. As tensions between the US and China escalated, securing a stable, cost-effective supply became increasingly difficult and expensive. To make matters worse, Tesla's vertically integrated production model, once seen as a major advantage, turned into a liability. Any disruption in one part of the supply chain could bring the entire production line to a halt. Unlike BYD, which had multiple battery production facilities, Tesla was locked into contracts with just a few key suppliers, limiting its ability to adapt when shortages hit. What was once a cutting-edge strategy had now become a serious obstacle, forcing Tesla to rethink how it secures the essential materials needed to keep its EV empire running. Tesla's vulnerability and fading technological edge. While other automakers diversified their supply chains, Tesla remained exposed to shifting trade policies, rising material costs, and logistical setbacks. The company was facing an uphill battle, and even its most loyal supporters began to question whether it could sustain long-term growth. But Tesla's supply chain troubles weren't just about batteries. They also revealed an even bigger issue: the company's fading technological lead. The decline of Tesla's self-driving edge. Tesla's full self-driving (FSD) and autopilot software were once considered the future of driving. Elon Musk had long promised that Tesla vehicles would eventually become fully autonomous, making human drivers obsolete. Early on, autopilot gave Tesla a massive edge, attracting tech-savvy buyers and setting it apart from traditional automakers. However, as time went on, the reality of Tesla's self-driving technology failed to live up to the hype. Regulatory hurdles, safety concerns, and a series of high-profile crashes led to lawsuits and government investigations. In the U.S., the National Highway Traffic Safety Administration, NHTSA, launched multiple probes into Tesla's self-driving failures, further damaging the company's reputation. Meanwhile, competitors like Waymo, Cruise, and even BYD were developing more advanced driver assistance technologies. Unlike Tesla, which relied solely on camera-based systems, Waymo and Cruise integrated LiDAR and radar-based technologies, proving to be more reliable in real-world conditions. As a result, Tesla's once cutting-edge self-driving software now looked outdated in comparison. The company that had once led the EV revolution was now struggling to keep up, not just in manufacturing, but in the very technology that had set it apart in the first place. Tesla's software struggles and aging lineup. In addition to falling behind in self-driving technology, Tesla's over-the-air updates often introduced new glitches, leading to unexpected braking issues, phantom stops, and erratic lane changes. These problems made headlines, raising serious concerns about the safety and reliability of Tesla's software. Once the undisputed leader in autonomous vehicle technology, Tesla now found itself struggling to keep up. The company had spent too much time making bold promises instead of delivering meaningful improvements, while competitors were rapidly closing the gap. But the issues didn't stop there. Tesla was also falling behind in new vehicle development, frustrating customers with an aging lineup and long-promised models that had yet to materialize. The delayed Tesla models. When Tesla first launched the Model S, it redefined what an electric car could be. The Model 3 followed, making EVs more accessible to mainstream buyers. But in recent years, Tesla has failed to significantly update its lineup, and customers are noticing. While automakers like BYD, Volkswagen, and Hyundai continue rolling out fresh models, Tesla has struggled to deliver on its biggest promises. The Cybertruck, Roadster, and the highly anticipated Model 2 have all faced years of delays, leaving potential buyers frustrated and impatient. The Cybertruck, first announced in 2019, was supposed to revolutionize the pickup market. But production setbacks, design revisions, and supply chain issues have kept it in limbo for years. Meanwhile, the Model 2, expected to be Tesla's answer to the growing demand for affordable EVs, remains nowhere in sight. Even Tesla's existing lineup is starting to feel outdated. The Model 3 and Model Y, which still account for the majority of the company's sales, have only received minor updates since their launch. Customers looking for modern interiors, new features, and better affordability are turning to competitors that offer more variety and innovation. In the automotive industry, staying ahead means constantly evolving. Tesla's stagnation is a major risk. New players like Rivian, Lucid, and NIO are introducing fresh designs and next-generation technology, challenging Tesla's dominance in ways that seemed unthinkable just a few years ago. Losing control of the narrative. The problem is clear. Tesla is no longer setting the pace for the industry. The lack of new models, combined with supply chain struggles and fading technological leadership, is pushing the company further behind in the EV race. But Tesla's troubles didn't stop with production and innovation. There was another major issue becoming impossible to ignore: Elon Musk himself.